Dame I gospodo,
Ladies and gentlemen, esteemed members of the press, dear colleagues, welcome to the presentation of the February inflation report. We will give you an overview of the current macroeconomic developments, our new inflation and economic activity projections, as well as monetary policy decisions in the period since the previous report. I would like to stress that the year 2018 was marked by positive economic trends. According to preliminary data of the Serbian Statistical Office, GDP growth equaled 4.4%, which is its highest increase in 10 years. Though the second half of the year saw a slowdown in external demand growth, domestic factors are to be credited for the high growth rate. Here, I primarily have in mind the improvement of the business climate, favorable financial conditions, positive labor market trends, as well as the accelerated implementation of infrastructure projects. Growth forecast for this year has been kept at 3.5%, while in the following years, that is in 2020, we expect growth to pick up further to around 4%, resting on sustainable grounds. Even in conditions of strong economic growth, inflation continued to move within the target tolerance band in accordance with our expectations. It has been low and stable for more than 5 years straight. In December, it measured 2% year-on-year, which is its average value for the whole of 2018 as well. For the following 2 years, that is until the end of the projection horizon, we expect stable inflation movements within the target band of 3 ± 1.5%. Serbia's economic program continues to yield strong results, as was recently noted by the International Monetary Fund. Favorable fiscal trends continue. In 2018, for the second year in a row, the budget posted a surplus and the central government public debt decreased to 53.6% of GDP at the end of the year. In January, it was somewhere around 50% of GDP. The fiscal policy, in full coordination with the monetary policy, is providing an impetus to economic growth without giving rise to inflationary pressures. The government's rising capital expenditures contribute to the rise in investment, while higher pensions and wages in the public sector are conducive to sustainable growth in consumption. In accordance with our projections, the current account deficit in 2018 maintained its share in GDP at the level from 2017, which is 5.2%, although imports increased on the back of higher investment and global oil price hike and the slowdown in external demand growth. At the same time, for the fourth year in a row, the high net inflow of foreign direct investment in 2018, equaling 3.2 billion, was more than sufficient to cover the current account deficit. The coverage equals 143.4%. At end 2018, we also have new data on the level of NPLs in total loans. It stood at 5.7% and represents another historical low of this indicator. Since we last met at the presentation of the November inflation report, the MBS Executive Board has kept the key policy rate at 3%. Which is its lowest level in the inflation targeting regime. In making such decision, the Executive Board has been guided by the assessment that inflation would continue to move within the target band over the projection horizon, thanks to, among other things, the effects of past monetary policy easing. Caution is warranted by uncertainties in the international environment, notably movements in primary commodity prices, pace of monetary policy normalization by leading central banks, and a possible further rise in protectionism in international trade. In the coming period, too, monetary policy will be predictable and consistent in delivering low and stable inflation in the medium term, which, along with preserved financial stability, will contribute to sustainable economic growth and stronger resilience to external uncertainties. The MBS will continue to carefully monitor and analyze trends in international financial and commodity markets and to assess their impact on economic developments in Serbia. I would like to use this opportunity to underscore that it was the strong economic growth and the results of the National Bank of Serbia in terms of maintaining price and financial stability that was cited as the reasons behind Standard & Poor's decision to upgrade Serbia's outlook from stable to positive in late 2018. At the end of my address, I would like to say that low and predictable inflation and a stable financial system, the achieved economic growth rates, balanced public finances, and the established downward trajectory of public and external debt testify to our commitment and readiness to respond timely and adequately to volatile external conditions. Allow me to conclude that this is an environment conducive to further growth in investment and competitiveness, and hence further rise in living standards on sustainable grounds. Having said this, I give the floor to my colleagues from the Economic Research and Statistics Department to give you a more detailed analysis of current developments and to present our macroeconomic projections.
Thank you. I will now give a detailed overview of current developments in the domestic and the international environment which motivated monetary policy decisions in the period since the last report, as well as of our new projections of inflation and economic activity. Given heightened uncertainty in the international environment, which has persisted for quite a while now and features as a key risk in our projections, I would like to start off with the external scene. Global growth outlook is weaker than 3 months ago, and almost all relevant institutions downgraded their projections of global economic growth for this and the following year. Weaker external demand and specific factors on the supply side in some members of the euro area, our most important trade partners, slowed down the euro area's economic growth and led to downward revisions. On the other hand, economic growth in the regions of Central and Southeastern Europe, which are also our important foreign trade partners, is likely to remain relatively high despite the mild downward adjustment. The slowdown in global growth and the decline in global oil prices from October until December last year led to lower inflation and downgrades in inflation projections for this and the following year in the majority of countries. Euro area inflation is still expected to trend below the target in the next 2 years, but at a level of 1.5% and not 1.7% as expected 3 months ago. Although futures suggest that the global oil price in the next 2 years will move at a current level of around $60 per barrel, its movement remains uncertain due to the impact of both supply and demand side factors. According to futures, no major changes are likely in global prices of primary agricultural commodities either. On the other hand, the leading central banks, the Fed and the ECB, proceeded with monetary policy normalization, announcing that it may be slower than previously suggested. The factors behind are the weaker global growth outlook and lower oil prices. Still, it remains uncertain to what extent the normalization of monetary policies of leading central banks will be slower and different from market expectations, which may affect global capital flows. Contrary to the uncertainty in the international environment, domestic macroeconomic conditions in which monetary policy is implemented remained favorable. Internal and external imbalances narrowed down significantly, which increased Serbia's resilience to developments in the international environment. This is also indicated by Serbia's low risk premium. A favorable perception of investment in Serbia is also signaled by the high net inflow of FDI, which in 2018 reached 3.2 billion euros, boosting the country's production and export potentials. The actual current account deficit matches our projection, and its share in GDP remained at 5.2%, despite the rise in global oil prices and higher necessary imports of equipment and raw materials for investment and industry needs. On the other hand, dynamic and diversified growth in manufacturing exports continued, as confirmed by the positive contributions from almost all manufacturing branches. Favorable balance of payments trends with the full coverage of the current account deficit by net FDI inflow also fueled appreciation pressures in the FX market, so the NBS intervened by purchasing 1.6 billion euros net in 2018. Thanks to this, FX reserves went up, which further strengthened our economy, making it more resilient to external influences. Owing to NBS measures and the achieved macroeconomic stability, citizens' confidence in the domestic currency and NBS monetary policy has been growing stronger each year. In this context, dinar savings recorded vibrant growth of almost 23% in 2018. The growth in dinar savings was also boosted by the greater profitability of savings in domestic currency, both in the short and long run, as confirmed by the analyses which are regularly prepared and published on the NBS website. The rising confidence in the banking system is evidenced also by the growth in household FX savings, which reached 10 billion euros at the end of 2018. Past monetary policy easing, low country risk premium and low interest rates in the euro area contributed to the maintenance of favorable terms of financing of the private sector and government. Along with the effects of rising economic activity and positive trends in the labor market, lending growth accelerated to 9.9% year-on-year in December, excluding the exchange rate effect. This growth was led primarily by higher lending to corporates in the last 3 months of 2018. If the effects of NPL write-off and assignment are excluded from the calculation, lending growth is even stronger, measuring 12.2%. In addition, the NPL share in total loans dropped to its new low of 5.7% in December, or by as much as 16.7 percentage points since the adoption of the NPL resolution strategy. Last year, we revised up the expected economic growth of Serbia on several occasions, and other relevant domestic and international institutions did the same. According to the preliminary estimate of the Serbian Statistical Office, GDP grew 4.4% in 2018, reflecting excellent results in agriculture, construction, and a pickup in the majority of service sectors. A positive contribution also came from the industry, despite the deceleration of external demand growth. We expect that the GDP growth of around 3.5% this year will be fully driven by domestic demand. Unlike the previous projection, when we expected a neutral contribution, we now expect net exports to provide a mildly negative contribution to GDP. This is primarily a consequence of the slower than expected growth in the euro area, where we see the risks around the GDP growth projection, particularly in the first part of the year. On the other hand, greater contribution to economic growth is expected from domestic factors, as indicated primarily by the significantly higher than expected net inflow of FDI and a faster rise in government capital investment, which have already approached the level of 4% of GDP. On the production side, we expect sustained growth in service sectors, industry and construction, while agriculture will most probably give a negative contribution due to the base effect. In the medium run, we expect economic growth to step up to around 4%, driven by investment, exports, and a sustainable rise in household consumption. In line with our November projection, year-on-year inflation continued moving within the target tolerance band, reaching 2% in December, which is also its average value for 2018. More than 3/4 of the contribution to inflation came from only 3 groups of products: vegetables, petroleum products, and cigarettes, suggesting generally low inflationary pressures. Low core inflation at a level of around 1% year-on-year, and inflation expectations of the financial and corporate sectors somewhat below the 3% inflation target additionally confirms subdued inflationary pressures. Our central projection, which is somewhat lower than the November one, shows that year-on-year inflation will continue moving within the target tolerance band, most probably in its lower part, until the end of the projection horizon. As in the previous projection, we expect that the rising aggregate demand will be the main inflation factor throughout the projection period. In addition, disinflationary pressures on account of the past appreciation of the dinar should gradually dissipate, while the rise in administered prices should be somewhat faster than in the previous years. The high base for vegetable and petroleum product prices will push inflation down in the coming period. The uncertainty surrounding the inflation projection relates primarily to the developments in the international commodity and financial markets and to administered price growth to a certain extent. The administered price hike might be lower than assumed, which is why risks to the projection are slightly skewed to the downside. At the end of today's presentation, I would like to draw your attention to the 4 text boxes in the February inflation report. The first text box deals with NBS's 10-year experience in the implementation of the inflation targeting strategy and the success it achieved in preserving low and stable inflation and in anchoring inflation expectations. The second text box analyzes the balance of payments in 2018. The third text box presents a global current topic, namely monetary policy normalization of leading central banks, and examines the potential effects on Serbia. The fourth text box analyzes our inflation and GDP projections made last year. Thank you for your attention. Now I would like to give the floor to Nikola Dragašević, and we stand ready to answer any of your questions. Now we will hear Mr. Nikola Dragašević, General Manager of the Monetary and Foreign Exchange Operations Department.
Thank you, Vice Governor. Now that macroeconomic developments have been presented, we will try to give an overview of the National Bank of Serbia's activities in the domestic interbank money market. In an environment of increased uncertainties, particularly pronounced at the turn of the year, the National Bank of Serbia succeeded in maintaining stability in the domestic financial market. We are keeping a close eye on global developments and strive to assess the potential effects on our economy at all times. A dedicated and proactive approach exercised by the National Bank of Serbia in the last 6 years, plus increased resilience to potential external shocks, has proved to be effective in maintaining the balance in the domestic financial market. Overall, in 2018, the foreign exchange market was broadly stable. This stability was largely underpinned by the central bank's timely reactions, above all to appreciation pressures that prevailed for the greater part of the year. Upward pressures on the dinar are structural and represent a continuation of the appreciation trend in place since April 2017. The strengthening of the domestic currency during the previous 2 years is a result of good macroeconomic fundamentals and positive prospects for the future growth and development of our economy. Greater inflow of foreign exchange came from different sources, such as foreign direct investment and non-resident investment in Serbian government long-term dinar bonds. Appreciation pressures were also sustained by the rise in remittances from abroad, as well as by increased inflows from tourism. Supported with data, the situation is as follows. In 2018, net demand of domestic enterprises for foreign exchange was nearly 13% lower than in 2017. Net demand of non-residents was cut by a third, 34%, while increased supply was seen in the segment of foreign currency cash, up by 13.6%, and card use by foreign tourists in Serbia by 7.5%. Both of these factors indicating increased inflow of foreign exchange from tourism. As a result of all of this, FX supply in the domestic market exceeded demand by more than 1.5 billion euros. Responding to stronger appreciation pressures in 2018, the National Bank of Serbia bought 1,580 million euros net. From April 2017 until end 2018, with its interventions, the National Bank of Serbia contributed to the increase in foreign exchange reserves by 2.7 billion euros, thus strengthening the resilience of our economy to potential shocks from the international environment. The start of the year is traditionally volatile in international markets. The major global economies and international organizations are considering downward revisions of growth projections, which is particularly evident in the euro area. trade tensions still remain, though over the recent days there are indications that an agreement between the United States and China could be reached. Uncertainties are also associated with the Brexit. Already now, it is certain that the normalization of the Fed and the ECB's monetary policies will be slower than announced. Uncertainties from the international environment have not reflected on the domestic market, which signals investors' long-term interest in Serbian dinar bonds and their confidence that the good results of the Serbian economy will be sustained. This is also confirmed by yesterday's report of the renowned financial institution JP Morgan, which highlighted long-term dinar bonds as a very favorable investment alternative and gave investment recommendations. In January 2019, occasional depreciation pressures emerged, customary for that part of the year. The dinar weakened 0.2% against the euro, and the National Bank of Serbia intervened by selling 130 million in order to ease excessive short-term volatility of the exchange rate. This pattern is customary and can be seen at the start of every year. It reflects the seasonally higher demand of domestic companies for foreign currency in an environment of the seasonally weaker supply of foreign cash. The obvious seasonality of depreciation pressures in January is also supported by data from earlier years. For instance, in January 2017, the dinar lost 0.4% and the National Bank of Serbia sold 225 million euros, while in January 2018, depreciation equaled 0.2% and interventions on the sales side 180 million euros. Already over the past several days, the matched foreign currency supply and demand and non-resident investment in dinar bonds of the Republic of Serbia led to the renewal of appreciation pressures, that is, dinar's appreciation in the domestic FX market. Wherefore, the National Bank of Serbia started engaging in purchase of foreign exchange for the first time this year. We expect the positive tendencies which impacted on relatively stable trends in the FX market to continue in the coming period. The fact that we act proactively in all segments of the domestic financial market has also been confirmed by 2 additional FX swap auctions held by the National Bank of Serbia late last month and in the first half of the current month. In conditions of temporarily reduced surpluses of dinar liquidity, the governor made a decision to organize on Monday, the 28th of January, the first additional FX swap auction in order to ensure smooth functioning of the money market. In this swap auction, the National Bank of Serbia supplied banks with the necessary dinar liquidity for a period of 2 weeks, while taking from banks foreign exchange as collateral. In doing so, the central bank used one of the standard instruments for regulating dinar and foreign exchange liquidity of the banking sector. The use of this instrument is optimal in situations of a temporary fall in dinar liquidity surpluses. This also helped prevent segmentation of the money market, where potential concentration of excess liquidity with no more than few banks could have led to a more significant rise in market interest rates, which, of course, did not happen. The first additional swap auction has already served its purpose. Liquidity of the banking sector improved, and the interbank money market continued operating smoothly. This, we may freely say, historical activity of the National Bank of Serbia in the money market was recognized, properly understood and very positively assessed by all stakeholders who follow market developments, from banks and key investors to renowned analysts. To enable the banking sector to gradually adjust to improve liquidity in the money market, and having in mind the maturing of prior additional swap auction, 2 days ago the National Bank of Serbia organized another additional FX swap auction with lower realization than in the first. In an environment of persistent structural dinar liquidity surpluses in the banking sector, reverse repo operations remain the main instrument for regulating bank liquidity, as well as for signaling the monetary policy stance and movement in short-term interest rates in the market. As so far, the National Bank of Serbia will keep a close eye on movements in the domestic financial market and react when necessary with available instruments in order to ensure its smooth functioning. Thank you for your attention. I will be happy to take any of your questions. Thank you. I will now give the floor to Milan Trajkovic, Deputy General Manager of the Economic Research and Statistics Department, to give you a brief presentation.
We shall now present to you one of the text boxes from the inflation report, which we consider important, and it deals with balance of payments trends in 2018. You've already heard that the current account deficit in 2018 was consistent with our projection and equaled 5.2% of GDP. What you can see in the left chart is the current account deficit and its structure in two multi-year periods. The first pillar shows the period from 2009 to 2012. The second pillar covers the period from 2013 to 2018. So what can you see in this chart? In the past 6 years, Serbia's current account deficit has almost halved compared to the period of 2009 to 2017. In the past 6 years, Serbia has increased its total exports by almost 10 billion euros, from 11.5 billion euros in 2012 to 21.2 billion euros in 2018. It is also very important to emphasize that we have seen not only an increase in exports, but in net exports as well. In 6 years, the deficit in commodity exchange has been reduced, and the balance of services turned from zero to a surplus of 1.1 billion euros. The secondary income has been stable, while the deficit on the primary income account has increased, which is normal in conditions of a high inflow of FDI. So what has happened when we observe only 2018? The current account deficit was in line with our projection and was kept at a level of 5.2% of GDP, the level recorded in 2017. The current account deficit was improved owing to rising surplus in the exchange of services, rising surplus in the account of secondary income, and a reduction in the deficit in the primary income account. Working in the opposite direction was the higher deficit in commodity exchange. We have four main factors contributing to this phenomenon. First, we saw rising prices of oil, petroleum products and gas of around 50 million euros. Then we also saw an increase in the imports of equipment for investment of 380 million euros. Then we also saw a rise in imports of different raw materials for industry purposes worth around 400 million euros. And finally, it was not possible to fully normalize exports of agriculture, which had a negative effect of around 100 million euros. The following slide shows the effect of rising prices of oil and rising imports of equipment on the current account. The left chart shows the current account deficit with and without energy products, as well as the energy balance and global oil prices. Average oil prices in 2016 equaled $44 per barrel, whereas in 2017 they rose to around $54, and in 2018, $71 per barrel on average. This is the key factor behind the movements in the current account deficit and the key factor in the increase in the deficit in commodity exchange in 2017 and 2018. We also saw a rise in investment and the relating imports of equipment. As you can see in the right chart, since 2015, imports of equipment has been rising each year. In 2018, they reached 2.8 billion euros, up by 380 million euros relative to 2017. The reason behind such increase in imports was the investment cycle, which started in 2018, and in 2015, and within 4 years only, we saw a cumulative rise in fixed investment of almost 30%, both private and government. As in the previous years, exports growth of Serbia was was led by manufacturing and exports of services. Within 4 years, manufacturing exports rose by around 50%, from around 10 billion euros to around 15 billion euros. After several years, during which it recorded two-digit growth rates, manufacturing exports slowed down slightly in 2018 and rose at a rate of around 9%. The reason for the slowdown was a reduction in external demand in the second half of the year due to the slowdown in economic growth in the countries that are our key foreign trade partners. This is what you can see in the left chart. You can also see that exports did not slow down to the extent that would suggest a slowdown in external demand because of new export capacities, which we expect to continue in the coming period as well. A very important contribution to growth in total exports also came from exports of services. In 2018, exports of services reached 6 billion euros. The greatest contribution to this increase came from IT services, which in 2018 reached 1,135 million euros, and growth will continue. And a continuation of growth was also seen in tourism and the exports of other services. And the last chart covers foreign direct investment. As you have already heard, the net FDI inflow in 2018 equaled 3.2 billion euros for the fourth year in a row. The net inflow was more than sufficient to cover the current account deficit. What is equally important is that in 2018, the FDI inflow in Serbia remained channeled primarily to tradable sectors, which increases exporting capacities and gives a good basis for growth and a reduction in the current account deficit in this year and in the medium run. And I would like to emphasize that this is one of the factors underlying our projections. So now I would like to open the floor for discussion.
Do your projections also factor in the slowdown in the euro area? Yes, our projections factor in the slowdown in the euro area. This is something that we pay most attention to, because the 1% fall in euro area's GDP affects Serbia's GDP by approximately 1% as well. The effect would be around 1 percentage point, perhaps slightly below 1 percentage point. And this is something that we definitely take care about. You should know that the reason why we maintained our GDP growth projection despite the slowdown in external demand at 3.5% are domestic factors, which gave a significant contribution to GDP growth in 2018. And we see that these trends are likely to persist this year. We are talking primarily about export capacities, about the performed construction works, and the growth of our service sectors. Is the forecast of a 3% growth optimistic if we know that the Albanians will not remove their tariffs, which we know will have an effect of 0.5% on the fall in our GDP? This means that our growth will be less than 3%. When it comes to agricultural production, you should know that what we have factored in to our projection is an average agricultural season, which means a fall in agricultural production in 2019. So this is something already incorporated into our central projection of 3.5% growth. And when it comes to Kosovo, our central projection implies the resolution of this issue, and the maximum effect that you have mentioned is possible only in case these tariffs remain in force throughout the year, and that all the goods not exported to Kosovo are not exported anywhere else. But of course, this is one of the downside risks to our projection. I wanted to add that there are risks to the projection, both upside and downside risks. This is our central projection, the 3.5% growth for 2019, but we do take account all the risks to euro area's GDP growth, and we assess the situation in its entirety. If there are no further questions, I will conclude today's conference. Thank you for your attention. Have a nice day.